Hey guys, it's Jack. A lot of people in the UK in the cryptocurrency space have been making a lot of mistakes when it comes to their taxes, especially when they're trying to avoid some taxes as well. This video will talk about some of the common mistakes people are making so you can avoid them and don't end up on HMRC's Christmas naughty list. Trust me guys, the lads and lassies at HMRC are not to be messed with. Also, I'm not a financial or tax advisor, so please seek help when necessary from a suitably qualified professional. It goes without saying guys that this video should not be taken as tax advice. So first things first guys is that a lot of people are thinking tax is only applicable when you withdraw money from your Binance or Coinbase or whatever exchange you're using to your bank account. They think because the money is in the exchange, it might not be real when it comes to taxes. This is simply not the case guys. Taxes will apply when you dispose of your asset, when you get rid of it. It doesn't matter if it's sitting as cash in your bank account or in your Coinbase or Binance or whatever exchange you're using. HMRC are going to be happy with a disappearing act. In fact, they might even pull off one of their disappearing acts by fining people or hitting you with a massive tax bill, maybe with interest. So make sure you don't treat your crypto exchange account as some sort of tax savior or some sort of tax wrapper, because it simply isn't one. In fact, HMRC have announced that they are exchanging details with the major exchanges, so be very careful. Another mistake that people have been mentioning in my previous video on tax avoidance is that they're thinking that putting money in something like USDT or any stable coin will give them some sort of win-win scenario. They might even be able to save on some tax, and they might be able to get some yield or interest from staking their stable coins. This is A, simply not true, and B, really frightening, and I'll tell you why this is frightening. The first point is that the government does not believe that USDT or any stable coin for that matter is a currency. They think it's a cryptocurrency. There definitely isn't no grey line there guys. It's crypto in the eyes of the government. They're going to be treating it as if it was a investment in Bitcoin or Ethereum, for example. Additionally guys, stable coins are not a tax wrapper. Let's say you made 15k on Bitcoin and you decided to put your money into USDT. You're going to be paying money, capital gains tax, as soon as you made a swap to USDT. When it comes to this, the second mistake is that people are thinking that the USDT is some comparison to the US dollar in any way, shape or form. Lads and lassies, let's not get greedy here. I know the extra interest payment may seem like a good shout, but you are risking potentially losing all that money you've made in the first place. USDT or any stable coin for that matter is not regulated by the government or any financial conduct authority for that matter. Remember, these coins are normally centralized, so there is a party or majority who controls the supply, but yet there is no benefit or security for you holding them. The providers can simply cease to exist one day, and you're going to be stuck in a very tricky situation where you might be thinking, oh, I wish I wasn't that greedy and I should have just took my winnings and paid the tax. It's not like you're going to avoid paying tax anyway by doing this. So putting your money in a stable coin is not an option. Not to mention that USDT is banned in New York. I mean, that sort of thing really gives it some credibility there. Another mistake people are making is thinking they can loan money against their crypto. On the surface, this sounds great. Let's say your tax is 10%, but your loan interest is just 3%. Then you might be thinking, loan money is fine, right? You can't pay tax on a loan. And this is very scary as well. While there is little regulation on crypto loans compared to the regular financial market, there are several issues with loans. Number one is that loans must be repaid. No crypto exchange or loan provider is going to leave that out of their terms of service. So really, it is just a short-term solution. You might not pay taxes today, but your loan will be recalled and you will be having to pay that back in some way, shape or form. But if you have found a way to do some complex loan agreement with an exchange where you're not going to have to pay back the loan, I want to remind you about the loan charge that was introduced by HMRC. Back in the day, some individuals took their salaries from their companies as loans. This was a scheme designed to essentially avoid income tax on a massive scale. HMRC found it out and our people are suffering. They're having to pay backdated taxes on some of those loans. So it's really hard. You can't get past HMRC and their rules. This meant a lot of people had to sell their homes or find a way to return that money to HMRC even with the interest. On a serious note, guys, don't do things that are gonna come back at you and haunt you later in life. Another mistake individuals are making is thinking capital gains tax applies on your investment. I.e., if you invested 14k, then you're going to be taxed on that amount. And it's simply not the case. Whether you have invested 12k or 14k or even $500, the capital gains tax applies on the gains. As the name says, it's the money you have made. If they are over £12,300, then you got to be worried about tax. If they are under, then you don't need to be worried about it at this stage. However, you must plan, because if they are over next year, then you won't be able to apply some of the tricks to avoid paying tax if you haven't planned in advance. I'll explain this in a second, but the key to remember is that capital gains tax is applied on the gains made. Also, another mistake people are making is that they're not calculating their wider portfolio of assets when calculating their capital gains tax. Another key thing about capital gains tax is that it applies together on property, stocks, crypto, and others. Let's say you made £12,000 on your crypto investment, but only £400 on your stock investment. Capital gains will still apply because the exemption of £12,300 has been passed. In the example I just gave, you're going to pay taxes on the £100 which is outside the exemption amount. So please keep your wider portfolio in mind when calculating capital gains tax. You might also consider selling some of the stocks in a particular year and holding on to some crypto. If you split your disposals out with multiple years, then you can easily use the exemption to the greatest capacity in multiple years. However, the key thing to remember is that if you're planning to do this, you're risking that your portfolio may fall in value next year when you plan to sell it. So please do bear that in mind and plan accordingly. Another mistake individuals make is to leave tax at the last minute. Now, you are exposing yourself to several risks. If the self-assessment is next year or has been extended to the year after that, you should always look to getting your taxes right today. Adequate planning will mean you're not only going to be saving yourself taxes, and I'll show you how and why in a second, but you might even be able to rest easy at night knowing that you don't owe any money to Her Majesty the Queen. Late filing fees for your self-assessment form start from just £100, but they can go even higher if you're even later with submitting your taxes. If you plan ahead, you can utilize the strategies like bed and breakfasting and plan for when you dispose of your crypto assets so you can fully utilize the fairly reasonable £12,300 allowance the government gives us. Another mistake people are making is not finding an accountant. You can easily find accountants on Google by just making a little search, accountants near me. But the key to remember is how you handle the relationship, the first interaction. Accountants are business owners, and ultimately they want clients that are stress-free and they can make good money serving them. I've had several accountants tell me that people have just called up asking for crypto tax help and just gave them no sort of paperwork, no sort of paper trail on how the money was made. Accountants will not take your case, guys. They will just say it's complicated and I don't know what to do. They don't want to get themselves in trouble, so make sure you're always documenting everything on what you buy, what you sell, the dates and the quantity, and the amount, of course, as well. Give them as much good info as possible. Crypto tax is not that complicated, and if an accountant is telling you they won't take your case, it's likely because they can't be asked to go through all the exchanges and dig out all your transactions for you. You've got to do the work as well. If you give them the right information on transaction, they will definitely take your case on. Which leads me to the next mistake, which is not using services like Coinly, Bear Tax, Crypto Tax Calculator sooner. These are some of the services, and there are much more online, which can help you calculate and track your crypto transactions really easily. Make sure you collect all of the transaction guides as soon as you're making them. Don't be lazy and think, oh, you know what, I'm just going to plug this in tomorrow. No, make sure you plug them in straight away so you have tomorrow's you thanking you when it comes down to the taxes you've saved. If you guys enjoyed this video, please make sure to smash that like button. I really appreciate it, and I'll see you in the next one. Ciao for now.